In accounting, we have some very important definitions, and we are going to start with the first one, which is assets. What is an asset? An asset is something that you own. It is a resource that you own or control. So examples of assets are cash, equipment, land, store supplies, that is supplies that you use in the store through which you sell your product, or you can have simply supplies, vehicles, buildings, and two others which you may not have heard of until today. And these are accounts receivable and notes receivable. Accounts receivable is a right to receive payment in the future. So when a business sells products or services to customers on credit, that is by agreeing to accept payment for them at a later date, they have a right to receive that payment in the future, and that right is an asset, which is called accounts receivable. Notes receivable is also an asset, just like accounts receivable. It is a right to receive payment. However, the difference between the two is that a notes receivable is a written promise that you have in your possession from the party that owes you the money, that they will pay you the money at a certain time, and very often notes receivable include interest on the amount that is owed to you. So we are going to cover accounts receivable and notes receivable in a whole lot of detail in Chapter 7. The opposite of an asset is a liability. So if an asset is something that you own, a liability is something that you owe. It is the claim that your creditors have on your assets. And in accounting, a liability is very easy to spot because it is oftentimes accompanied by the term payable. So examples are accounts payable, notes payable, taxes payable, wages payable. So let's first talk about accounts payable and notes payable. These are opposites of accounts receivable and notes receivable. So if accounts receivable is a right to receive payment in the future, and accounts payable is an obligation to make payment in the future. So if you buy products or services on credit, you have an obligation to make a payment for these at a later date, and that obligation is termed as accounts payable. Notes payable is also like accounts payable, but is a written promise that you've made to someone that you will pay them the money on a particular date, and along with interest if those are the terms of the note. If you owe the government taxes, or if you owe any other entity a tax, that is a taxes payable liability. If you owe your employees wages, you have wages payable. If you owe your landlord rent, you will have rent payable. If you owe the bank interest, you have interest payable. So this is not a finite list. These are just some examples of liabilities that you have. Equity, on the other hand, is the owner's claims on the asset, what the owner has at stake in the business. And equity is made up of two components: contributed capital, and for now, to keep it simple, we'll call it common stock, and retained earnings. So the two components of equity are common stock and retained earnings. And these two items contribute towards equity, and there is one item, dividends, which takes away from equity. And dividends are a return that is paid to stockholders for the shares of stock that they have in the corporation. We know that common stock is the shares of stock that shareholders buy in the corporation. So we don't really need to discuss that in a whole lot of detail at this time. But I would like to talk about retained earnings. Retained earnings is the income that a corporation has earned since its inception that has not yet been distributed to its owners in the form of dividend. So what contributes towards this income, and what takes away from the retained earnings? So when a business earns revenues, those revenues increase retained earnings. And when a business incurs expenses, those expenses decrease retained earnings. Dividends are also paid out of retained earnings. So when dividends are paid, these decrease retained earnings. So revenues add to retained earnings, expenses take away from retained earnings, and dividends take away from retained earnings. So what are revenues? What are expenses? What is dividend? Revenues are the amounts that you charge your customers for products or services that you provide to them. Revenues are the assets that are earned from the company's earnings activity. And so the type of revenue will depend upon what the earnings activity is, what the operations are. For example, for a service business, their revenues are often called fees or fees earned or service revenue. For a business that sells products, their revenues are called sales. For a business that rents out property, their revenues are called rent revenue. Or someone who earns interest, the revenue is oftentimes called interest revenue. And once again, this is not a finite list. Expenses are the assets that are used up in the process of earning revenues. So we cannot just be earning amounts. We have to incur some amount so that we are able to earn those revenues. And so expenses are the assets that get used up in the process of earning revenues. And so we label the expense based upon what it was for. So if we pay our employees wages, we have wages expense. If we pay our tenant, our landlord, if we are a tenant and we pay our landlord rent, we have rent expense or utilities expense. So these are examples of expenses. Net income or net loss is the difference between revenues and expenses. So if revenues are greater than expenses, we have net income. And if on the other hand, expenses are greater than revenues, we have net loss. Dividends are a distribution of the corporation's earnings to its shareholders. So we talked about dividends a few minutes back, that dividends are paid out of retained earnings. So we want to take a look at retained earnings once again. Oftentimes we have to compute a missing component from retained earnings. So retained earnings is income that has not been distributed to shareholders. And so we start off with how much retained earnings we had at the beginning of the period. So if you're talking about a year, at the first of a year, what was the balance of retained earnings? Now this balance is going to change if the business is in operation. So retained earnings will increase if the business earns revenues, decrease if it incurs expenses. So the resulting amount is net income or net loss. So if I combine revenues and expenses together, I can have either net income or net loss. So now I can say to this balance of retained earnings at the beginning of the year, I add net income or subtract net loss. And then I subtract out dividends, and that gives me the ending balance of retained earnings at the end of the year. So this is how retained earnings changes from the beginning of the year to the end of the year. Next, we talked about assets, liabilities, and equity. And these three items have a very important relationship that forms the basis of all that we do in accounting, how we record events in accounting. And so what is this relationship? This relationship is best expressed in the form of an equation: assets equal liabilities plus equity. And this equation should always be in balance as we record events, as we record transactions. So a transaction is any event that causes some change in this accounting equation. So a further explanation about why this equation remains in balance. So if we have assets that equal liabilities plus equity, and if we have assets of 10,000 and liabilities of 7,000, our equity is bound to be $3,000. So we keep this equation in balance as we record events, as we record transactions. So how did this equation come about? We get resources by either borrowing money to acquire those resources or investing some of our own money or using the money that the business's operations generate. That's how we acquire resources, right? So resources are referred to as assets. Our borrowings are referred to as liabilities. And what we invest in the business and what the business generates through its operations is referred to as owner's equity. So we have assets, resources equal liabilities, our borrowings, plus owner's equity, which is our investments, plus what our business generates in the form of its operations. If we expand this out further, owner's equity is made up of common stock and retained earnings. And if we want to expand it out even some more, we have common stock plus revenues minus expenses minus dividends, which make up retained earnings. Now we are going to talk about how we determine equity. How do we determine equity from the beginning of the period to the end of the period? And I must tell you that this slide, as well as a slide on retained earnings, determining retained earnings, is very, very important for chapter 1. We use it in several places to solve several problems. So make sure that you thoroughly understand it. So we start off with the beginning balance of equity, what we started the first of the year with if you're talking about a whole year. To that, we add additional investments or stock issuances made by the owners in the business. So when we issue additional shares of stock, those are additional investments that stockholders make in the business, and that increases equity. And equity is also increased as a result of net income and is decreased as a result of net loss. And if we expand that out further, net income is essentially revenues minus expenses. Dividends will decrease equity. And if we add up all these amounts and subtract the dividends, what we get is the ending balance of equity. So what you see here, starting net income and dividends, we also saw with respect to retained earnings, because equity is made up of common stock and retained earnings. So both of these impact the balance of equity. So what I would like to tell you now here is that when we have a transaction, that is going to impact the accounting equation, and the way we record it is by keeping the accounting equation in balance. So I would like you to look at the video for the transaction analysis for Red Company that you have as part of your chapter 1 material. And I want you to go through each transaction. I have walked you through all the transactions there, and so I want you to go through it in great detail, because that creates an understanding of how transactions impact the accounting equation, and that is going to prove very beneficial for us throughout the course and particularly in chapter 2.